Hello everyone. Today in this session, we are going to learn about one of the approaches of security analysis. An investor or an analyst, before investing in a particular share, analyzes that security or share based on its prices. The movement in these prices are analyzed mainly using two approaches. The first one is fundamental analysis. The second one is technical analysis. Before going into the details of technical analysis, let me explain or give you a brief note on what fundamental analysis is. It is an approach through which an analyst tries to evaluate the intrinsic value. I shall write it as IV. Intrinsic value of the share by analyzing the various factors that could affect the price of the share. Factors pertaining to the economy, industry, and also the company. This analytical framework is known as Eic Analysis. Once the analyst obtains the intrinsic value or the true worth of the share, he compares the intrinsic value with the current market price of that particular share. And based on this comparison, he will be deciding whether to buy or to sell that particular share. So, if the intrinsic value is greater than the market price, the security is said to be underpriced. And hence it's a good time to buy that security. And in a situation where the intrinsic value, this is another situation where intrinsic value is less than the market price. That is, the actual worth of the security is less than what it is sold for. In that case, the security is said to be overpriced, and hence this is the time when you can sell that particular security. It's a good time to sell that particular security. So, in a nutshell, fundamental analysis is analyzing the security based on the economy, industry and company related factors and deciding the trading strategy by comparing it with the market price. Now, let's move on to the today's topic, that is technical analysis. In technical analysis, an analyst tries to evaluate the security based on the historical prices, and the volume of trading. Now let's see how. The price of a particular share is determined by the demand and supply forces operating in the market. I shall write demand and supply here. The demand and supply forces operating in the market. This demand and supply in turn is influenced by many other factors. Some of them are, the first one is fundamental factors, the factors that we just covered under fundamental analysis. Those are factors pertaining to the economy, industry to which that security belongs, and also the company itself. And then the second set of factors are the emotional factors. Emotional, or you can also term it as psychological factors. Emotional or psychological factors include investors' behavior or investors' expectation. It can be a fear or a hope or an ignorance that could affect the demand and supply of that security. And other than these, you have inside information too. Inside information or insider information. Insider information is a fact or an information about the company which is not easily accessible or which is not available to the general public. For example, it can be company's decision to issue bonus shares or a rights issue, or it can also be a problem that between the management and the labor that's there in the company. That also could affect the price. So all these factors may not be quantifiable. Even though it's not quantifiable, the combined effect of all these factors is reflected on the market price. So what the technical analyst claims is that we need not analyze these factors. We just need to analyze the historical price of that particular security. And also the volume of trading, that is number of shares that are being traded or number of shares that were traded in the past. So by analyzing these two factors, you will be able to select or decide upon the trading strategy. The analyst analyzes these historical prices using charts, mathematical indicators, oscillators and Dow theory. Now, what the analyst usually does is he identifies patterns in these charts and then looks for similar patterns in the price trends, and that's how he predicts the future trends. Now, let's look into the assumptions of technical analysis. Assumptions. The first one is the market discounts everything. The market discounts everything. Here, the technical analyst assumes that all the past factors that could possibly have an impact on the stock prices is already reflected on the market price. Be it the fundamental factors or emotional factors or a natural calamity, or let's take the pandemic COVID-19. All these factors have a reflection or an effect on the market price and is already reflected on the market price. Here you can see a technical chart which is a line chart of the index Nifty 50 of the last 6 months, that is from Jan 2020, that is 27th Jan 2020 to 27th July 2020. If you see the date March 23rd, you can see a dip in the Nifty 50 to a very low point. This is how all the factors of the economy or let be political, it has an impact on the stock prices. The second assumption is that market prices moves in a trend. Here the analyst assumes that the market prices either move in an upward trend or in a downward trend. And the third assumption is that history repeats itself. The analyst assumes the prices to move in the same pattern as it was in the past. This is because of two reasons. The first one is, since a set of factors that were in the past tend to repeat, the outcome also tend to repeat. The other reason is human psychology. Whatever be the situation, human tends to have a similar behavior. That is, either it is a fear or an ignorance or a hope. So these patterns also tend to repeat. Here you can see two technical charts. The first one is a line chart of Nifty 50 of the last 3 months, that is from April end to July 27th. The second chart is again a line chart of Nifty 50 but it is of the last 1 year, that is from 27th July 2019 to 27th July 2020. We'll discuss about the various patterns in these charts and also the other tools of technical analysis in the next class. That's all for today's session. Thank you.